After months of lockdown, factories in China are now back in operation. Commercial establishments have reopened and people are returning to work. But it's hardly business as usual.
Production recovery could be quite fast once you remove all those people movement control. But what's lagging is still the consumption side.
2020 was to be a key milestone in China's economic trajectory, marking the time when it would double its GDP from 10 years before.
They were on track to do that, in fact on track to meet it quite easily. They needed about 5.8% growth in 2020 to achieve that. Of course, COVID-19 has completely pulled the carpet out from that strategy, and I think there's no way in reality that China is going to get to anything like 5.8 or 6% growth this year. So I think that target is now out of reach.
The Chinese economy shrank 6.8% on year in the first quarter of 2020, marking the first contraction since China began releasing official quarterly growth. Hospitality, retail and manufacturing were among those posting double-digit declines.
So in the first quarter of this year, the Economist Intelligence Unit estimates that China's economy shrank by 10.9% on a quarter-on-quarter basis. In the second quarter, we're expecting a recovery of plus 9.2%.
On year, OCBC says second quarter growth could be around 2.1%.
The first quarter maybe marked the bottom for Chinese growth. So what can potentially drive the growth in the second quarter, in my opinion, is the production and the investment.
As for the full-year forecast, OCBC says this depends on whether the world can fight off the pandemic.
Roughly about 1.2% to 3.6% depends on the development of the COVID-19, for example, and the global economy can restart, from the second half onwards. I mean, there is a chance for us to see the Chinese growth to still grow maybe around 3.5, 3.6% for this year. But if not, then of course, I think we might see the growth can go down to as low as 1% range.
A potential resurgence of the COVID-19 outbreak during winter poses a fresh threat, experts say. But China's biggest headache is falling demand as global economies remain shut.
We are seeing the problem has been shifted from the supply side shock to the demand side shock. So this external demand is going to affect the job stability in China, affect the profitability in Chinese companies.
Profits for industrial firms took a beating in the first quarter after China's massive lockdowns forced companies to halt production activities. Economic consultancy firm Trivium China says overall business activity now stands at 82.8% compared to pre-virus levels, with a majority of large companies back in operation.
The recovery can't take place properly until the virus is under control. That could mean many different things. It could mean virus mutations so that it becomes less virulent. It might be a vaccine. It might be the safe distancing and lockdown measures, just reducing transmission to very, very low rates. There's a number of ways that it could go.
While tourism, hospitality, retail and F&B will remain under pressure due to their sensitivity to lockdowns and travel restrictions, other sectors could see significant growth.
I think 5G and technology will continue to be one of China's strongest sectors, and the government will probably accelerate investment in 5G as part of its recovery package. And then healthcare, naturally, another sector that will see more spending and an increase in output over the next 12 months. Trends such as automation, which was already a big one, particularly in manufacturing, but also in services. I think that trend will accelerate.
Investors looking into China could find opportunities in the tech space.
I tend to look at, the Alibabas and the Tencents, those sort of large stocks. Domestic consumption might have a catch-up, so in the next quarter or two, they may do quite well. I wouldn't be so keen on luxury or luxury goods because I think that there's going to be a general feeling, not just in China but around the world, that people don't really want to spend, that they've had a bit of a scare now, and they're going to want to try and keep their money to themselves.
But even as China ramps up its economy, some caution. It might be best to stay on the sidelines.
I'm basically recommending that they sit on their hands first of all, and just have a look, see what's happening to the economy, see what's happening to the markets. After a 20% bounce, it's pretty unlikely the markets are going to run away from this point.
As the world looks to China's economic path, experts say its first quarter report card could be a reference point.
In the first quarter, the Hubei's economy contracted by almost 40%. So that's very significant numbers. So I think to me, I won't be surprised to see the economic growth in Europe or in US to contract by to double digit in the second quarter, like a 10% or 20%.
I think there's going to be a long, slow recovery in the West, and that's likely to be mirrored in China as well. We've never seen the kind of V-shaped recovery in China that we were hoping. It's more like a reclined hockey stick, and I think that that's going to be the kind of model we should be looking at for the rest of the world as well.
Experts say China could unveil more fiscal and monetary stimulus ahead, but it may be constrained by high inflation and rising debt levels in the economy. And while intra-regional trade and tourism could have a spillover effect from China's economic recovery, this too may be limited.
China is not going to be just a winner out of this, though. It's going to find some things become a bit more difficult. The US-China trade war, or tensions more broadly, I think are going to be exacerbated by this crisis. And it certainly has also shown up some of the difficulties in China's system. And I think that's going to cause some challenges for China's international engagement. And there's going to be some difficult conversations around the debt that has been extended as part of the Belt and Road Initiative.